Now with my guest, Patrick Barbe from BNP Paribas Investment Partners, we will look at future triggers for bond markets. Patrick, are you expecting further catalysts for bond markets, potentially from the US Federal Reserve?
We expect a normalization of the monetary policy compared to the last figures we got on the US economy. We have positive signals due to internal economy, consumer spending, I would like to say corporate profits, finally better than expected. On the other hand, the dollar is stronger than expected. The energy activity is going down, which could impact the US economy. So this is an average better economic picture, just justifying a normalization of a monetary policy, the start of a normalization. So it means higher rates, and that's all. For us, the question is more about the repricing of the whole market, I mean the credit market, and the shape of the curve. The yield curve is perhaps too flat if you take into account that we have a new economic picture ahead of us for the US economy and for the UK economy.
Are you worried about a Greek exit from the Eurozone?
The Greek exit is a difficult question because it's finally a political question. What is sure is that when the Greek elected a new government, I mean extreme left party, it stopped the economic activity. I mean, corporate postpone investment expenditures. Some outflows were known by the banks. So, globally speaking, the economy fell down, waiting for the measures, the new government policy.
And here in London, Patrick, we've got two parties. They're at each other's throats about economic policy just before the election. But if we look at the forecasts, 2.6%, 2.7%, it doesn't seem to be a huge amount of difference whoever gets in for bond markets. How do you feel?
I feel again that this is the result of a very accommodative monetary policy which force investors to buy safe assets and then not take into account the economic short-term picture. The question you raise is it a sustainable growth pace? Yes or no? Is it going to bring an acceleration of the economy spreading to the wages? The question for bonds market is still about the wages. This economic recovery in the G7 countries, except Germany, is not bringing higher wages. In Germany, it's another story because wages were stable for more a decade than a decade. So to have higher wages now, it's a sort of a way to offset what happened in the past. But today, the market is still optimistic, positive on bonds because there is no diffusion of the better economic picture to the wages. Jobs which were created in most countries are poor quality jobs for the time being. Not so much engineer, not so much in the technical industry. IT sector is not so much buoyant, as you know, especially in the States. The new economic picture is based on the biotech. New technologies at this period of time is difficult to check what could be the consequence for the whole economy. It's better, it means positive growth, attractive one in the UK, for example, but what could be the consequence in the macroeconomic terms that is important for bonds market today we don't know. And that's the reason why the market is stable. Okay, stable, positive.
Patrick Barbe, thank you very much.
Thank you.